Okay, so today we've got a special presentation about multi-time frame analysis. We've spoken about multi-time frame analysis before. I wanted to do a deeper dive into multi-time frame analysis and what multi-time frame analysis allows you to do. There's so many benefits to multi-time frame analysis. The first is that it really helps you identify entries with greater potential for profitability. And the reason why is when there's a setup that has that's lining up across multiple time frames, and the time frames that I typically look at are the monthly, the weekly, the daily, and the 30-minute. Well, we'll take a closer look at all these, but when you start to see setups lining up across multiple time frames, I would say at least two. If you have three, great. Four is rare, but those ones tend to lead to some of the biggest moves. And the reason why is because you've got more eyeballs on them. And we'll go into that deeper as well. Multi-time frame analysis also allows you to exit with less risk. And the reason why is because you're able to typically exit closer to the danger zone. When you get multiple time frames lining up, you're able to buy closer to where you would set your stop loss. And for that reason, you're able to take less risk on the trade overall. On the upside, you could capture more profits with better risk management. So you'll be able to, as trades progress, it's almost like akin to flying a kite. Right? If you've ever flown a kite, you know that, well, when you're first getting it off the ground, you kind of have to hold the string real tight, and you run, and the kite starts to go in the air. I'm thinking about kites because I was flying kites with my daughter the other day. And so you kind of hold onto the string tight, and then as the kite gets further and further into the air, you could give it more slack without worrying about the trade falling off. And if you hold it too tight when it's made progress, then that's it struggles. So understanding when to give trades more room, when to give trades less room, and at different times, multi-time frame analysis helps with all that as well. So finally, before we get started, who is this course for? This course is for anyone who is an experienced trader that wants to get better. This can help improve all trading styles, whether you are somebody that is longer term, whether you're somebody that is shorter term, whether you are someone that is swing trading, like myself, even for day trading too. This can help out for all those different styles. And finally, this is also for people that, if you're someone that is new and you're curious about multi-time frame analysis and you enjoy diving into the deep end of the pool, then you'll probably like this as well. Now, before we go further, does anybody have any questions yet? I got a note here from Gigi that he's having trouble hearing me. Yes. Can everybody else hear me?
You're loud and clear, Mike. On my end, anyway.
Yeah, hear you too.
Okay, so I just sent Gigi a note letting him know that problem is on his end. Hopefully he's able to get it rectified. If not, Gigi, we've got the recording for you. So on to the next slide. Now, before we get into the nuts and bolts of all the different of how to do the the multi-time frame analysis, let's put some of the myths to rest, because there are some myths about multi-time frame analysis. The first one is that it adds a lot of complexity and can lead to information overload. I used to think this as well. Now that I know better, I would actually argue the opposite point, that it reduces complexity because it narrows down your trades. So if you set a criteria for yourself that you will only take trades that are lining up across time frames, then it will reduce the amount of trades that you end up taking. So it'll reduce complexity overall. It'll reduce the information that you're taking in, because rather than having, say, 10 trades that are all setting up and it's all, say, a cup with handle or VCP, there's likely only going to be a small handful of them that are lining up across time frames that have at least 2 time frames. Even less are going to have 3 time frames that are lining up together. So multi-time frame analysis can actually reduce complexity and help you narrow down trades. The next is that multi-time frame analysis is time consuming. If you follow our other pre-screening methods, so starting off with a universe list that you have that has specific criteria in it, you could screen for whatever you want. Those of you that have been following along for a little while know that I like to screen for both high earnings and sales, all the elements of a growth stock. I screen for some technical criteria, and I run these screens consistently every single week. That is going to narrow the field tremendously in itself. Then from there, I'm going and I'm taking a look at all the different trades that are setting up. And I have specific criteria for what I'm going to define as a setup versus something that isn't setting up. So because I've already defined what it is that I'm looking for, that's also narrowing the field. So by the time I actually get to the part where I'm going through and looking at individual setups with a fine-tooth comb, there's only going to be a handful that I'm doing this multi-time frame analysis on. And so if it's adding minutes to your week, I actually think that it's a lot. Did I hear a question? Question, comment? No? Okay, we'll continue then. Yeah, feel free to jump in at any point. Last myth that I'd like to put to rest is that multi-time frame analysis leads to over-trading. Kind of mentioned why in the first part of it, but waiting for confirmation across time frames will actually prevent you from over-trading. So if you have, let's say you've got a trade and there's, you're only able to identify the setup on one time frame, then if you discard those and only take trades that have that are setting up across time frames, then it's actually going to help prevent overtrading. Any thoughts on any of these before we continue? I'll take a quick drink of water while I wait. No? All right, let's keep going then. Next, what we're going to cover here. I'm going to cover 4 key topics. 4 key topics are hunting like an eagle, entries, finding rock solid support and resistance levels, then moving from good to great, using price and volume range decline for your setups. We'll get into that. And finally, exiting trades and how to set stops using multi-time frame analysis. So let's dive into the first one, hunting like an eagle. The 4 time frames to consider. most of you know this already, but we'll go through it and give some perspective on each one and why I'm looking at each one. So first, the monthly. The reason why I look at the monthly at all is because it gives perspective of the overall move. Next is the weekly. On the weekly charts, I'm looking for structure. That's where most of the base patterns will be clearly visible, and those are the ones that I want to be trading with that intermediate term trend. The daily time frame. The daily time frame is going to add a lot of context to the moves that you're seeing on the weekly. You'll be able to see accumulation and distribution clearer. You'll be able to see if price is being sold off or if it's being bought at key levels. You'll be able to see some of the nuances of if it's tightening up. And then when you get down to the 30-minute, you'll really be able to see the nuances of the pattern, particularly around the pivot area, and you'll be able to get very surgical with your entries and your stops and the entire setup. To show you what I'm talking about here, let me reset some of these charts. Very briefly, we've got the monthly time frame here, and the setups that we'll be looking at are these ones here. But for right now, this is a monthly chart, this is a weekly chart, this is a daily chart, and this is a 30-minute. And I like to keep all 4 time frames on my screen as I'm going through trades. And the reason why is because it makes it a lot simpler to be able to see where levels line up. And as we go through each of the samples later on, you'll see exactly what I mean. But for right now, know that the preferred way to have this, my preferred way to have this set up is to have a monthly over here, weekly over here, daily, and then the 30-minute time frame down there. Okay, now how do you find the rock solid support and resistance? The first thing that we're going to want to do is look across time frames to find different confluence levels. After that, we'll want to use the technical indicators from the time frame that you're trading. So, for example, I'm trading based off of the daily charts. So all the other time frames are going to have elements of the daily charts in them, even the weekly. If you're familiar with the weekly charts that I use, you might say, well, you're using a 10-week line and a 40-week line. How does that line up? The 10-week line is the equivalent of the 50-day moving average, and the 40-week line is the equivalent of the 200-day moving average. On the 30-minute time frame, I'm pulling in all the moving averages from the daily and observing it down there, and I'll show you how to do this too. So the examples that we're going to take a look at, well, we've got 5 examples: SMCI, Dash, Weave, ELF, and NVIDIA. And pro tip, when identifying entries, we want to zoom in. So let's go through some of these names. And the reason why I've selected these names is I've traded each of these, except for NVIDIA. NVIDIA's been on the radar for a long time, but I haven't traded that one. Many of you have, though. Let's start off with SMCI. So SMCI, the first setup, the first time that it came on the radar was way back here in May. And in May, it was setting up in, what pattern is this? Does somebody want to shout it out? We're looking down here on the weekly. This is what's known as a short stroke pattern. It's the shortest pattern in the O'Neill Can Slim playbook. I'm trained by that group. For those of you that don't know, I was an IBD meetup leader for about a decade. I've been to most of the courses that IBD that provides. Huge fan of O'Neill, obviously. If you've read my book, you know how much of an influence he's had on me. And one of the patterns that he talks about is the short stroke pattern. What the short stroke pattern is, it starts with this big run up in price, followed by a almost like a short pen stroke near the high of the prior week, and that occurs on low weekly volume. So this is a classic short stroke pattern. Now, the way to enter this would typically be break above the high with a stop below the low of the week. So if I'm looking at it from that perspective and I come down to the daily time frame, and I've got this marked over here, and why don't I drag the 30-minute back over here and zoom in a little bit on the 30-minute time frame so you could see that a little bit better. So all these drawings are lined up across time frames. They would show up on the monthly as well, but it's so tight that you can barely even see it on here. So look at the weekly, the daily, and then the 30-minute down here, and you can see how this area is tightening up across time frames, and how that's a significant level on each of these time frames here. So when price starts to break out, and price is breaking out on a Tuesday, so that means that you're breaking above the weekly high, and you already have last week's low as your stop loss area. So this thing is starting to break out here, and it's breaking out across time frames. Great. As it's moving up, and then it starts to consolidate here. This is where my most recent entry in this thing was. And you can see here too that it's pulling back to the 21 period exponential moving average. And this moving average down here on the 30-minute is the daily 21 EMA. If you have TradingView, the way that you would set that up is to go to all the different moving averages that you have over here. You click the little gear icon, and then what you would do is when you have the indicator time frame up here, it looks like they actually changed the layout of this a little bit, but you would still go to the indicator time frame, and typically it's defaulted to the chart. You want to switch it over to the day, so that way when you're looking at the 30-minute and you're trying to get surgical with your entry and your stop and all that, you're able to see the daily moving averages. So in this case, when I saw this pulling back over here on the weekly time frame, you might look at a weekly time frame and say like, oh, this looks like it's destined to test the 10-week line. But if you start to look at the daily time frame, you can see that price is starting to come in, volume is starting to taper off a bit relative to what it was back here. It's starting to taper off a bit and starting to move sideways around the 21 period exponential moving average. Perhaps it's starting to round out something down here. Maybe it's not quite as clear on the daily, but then when you start to look at it down here on the 30-minute, it starts to become clear as day, at least to me, where it's touching the 21, shakes out a little bit below it, starts to round out, gets even tighter, and it's below this trend line as well. Sometimes you have a trend line, sometimes you don't, but when you're incorporating all these different time frames, it starts to become a little bit easier to see. When I drew this one, So I initially saw it on the daily, so I drew it on the daily, and then I popped open the 30-minute, and I was able to see it a little bit clearer here on the 30-minute time frame. As price was starting to break out of here, that was my entry point, and that's actually around where I entered this the first time with my stop loss down here. And so from there, was able to ride this. And was actually exited up here, tried to get in again around here, and based on what price is doing right now, I'm probably out of this one. Yeah, I'm pretty sure I had my stop loss right below this recent low over here. This jumps ahead a little bit, but yeah, for the sake of the example, you could start to see like how price was testing, broke out over here, tested support around the 320-ish level, and then at least for right now, it's broken that level. So that's why that's the exit point there. Thoughts or questions on SMCI before we move on to Dash and Weave and ELF and NVIDIA? We can always come back as well. All right, so here's Dash. Dash is one that I saw setting up way back here, right? And so if we're looking at the different time frames here, reset all these charts. And get rid of that alert so it's a little bit clearer. This was setting up back in this zone here. So the setup developed, this consolidation developed between February and finally broke out in June. Now, this breakout is a rare one. And the reason why I say that it's rare is because you have it breaking out not just on the weekly, the daily, and the 30-minute, but it's also breaking out over here on the monthly time frame. And you notice when it starts to break out over here on the monthly, you had some volume coming in back here. A volume on the monthly chart, on the daily chart, on the weekly chart, I should say. And yeah, even down here on the daily, like volume was not tremendous on the breakout. You notice that, right? Sometimes volume is heavy on the breakout, and you, of course, we've been taught that when you have heavy volume and prices moving, then that shows demand. Price can sometimes move without the heavy volume, and I think that this shows that. Would I be more comfortable if I saw the heavy volume? Sure, but it's not about how comfortable I am. It's about is this following the rules that we've set? And the rules are trade breaks out and it's progressing and it's not doing anything particularly wrong per the rules that we had, right? If this doesn't violate anything, then it's fair game. Notice this setup here, right? It's consolidating below this area, and I'll zoom in over here on the daily time frame because the stop placement on this one got to be pretty tight. On this, you might say that, oh, on the weekly I'd put a stop down here, but when you start to look down at the daily time frame, and then when you start to zoom down into the 30-minute time frame, that's where you could start to fine tune some of your stops. So on this, the appropriate place for the stop was right down here, right below this bar. The reason why is because it's below that day's low. It's below the 21 EMA. If you take a look at the weekly chart over here, this point is below the weekly low. And that's one of the advantages of entering midweek, because you end up getting the weekly low as support. And then down here on the 30-minute, you can see how price ran up to this level, pulled back, and then broke out. So if the breakout were to fail, it would need to take out this level, right? If the breakout is going to work, then this is a level that should hold. Right? Think of it like this. Let's say that this is the first floor of a building. You walk up here. Now you're on the second floor. You walk upstairs to the third floor. And then it's just like, let me go back downstairs. You go back down the stairs. Now you're back on the second floor. Then you head back upstairs to the third floor. If you come back downstairs to the second floor, you shouldn't fall through the floor. Hey, like you want that floor to hold. So if that floor doesn't hold, then see you later. This house isn't safe. But if it does hold, then you're okay. All right, so that's what happened with Dash. Here's Weave. Another example. This one over here had run up significantly. You can't really see it very well on the weekly time frame, at least the setup that was taken. But this had run up about 100% in 1, 2, 3, 4, 5 weeks. Right, so this is looking to be a power play right here. Sometimes it's difficult to find entries on some of these names that run up very quickly. And the reason why is because the distance between the top of the weekly chart and the bottom of the weekly chart is so wide. If you wanted to enter on this breakout and have your stop below the weekly low, you'd need about a 9.5% stop. I don't know about you, but that's a lot for me. So when I come down here, I start to look at the daily time frame, and then I try to get surgical with the 30-minute. If I'm entering above this little flat top area here, and why don't I make this larger for a moment? If I'm entering over here, and I've set a stop down here, now all of a sudden I've got about a 5% stop on this one, half the risk. Price breaks out, and then it's off to the races in this event. On the 30-minute, same lines as the daily and the weekly that we saw before. Price is dancing around the 10 EMA, and you can see how price was bouncing off of it back here, tested it over here, bounced right off of it over there, tightened up, and then broke out. Then when it pulled back, what happened? It bounced right off of the 10 EMA right there. And then continued. When it pulled back over here, where did it pull back to? It pulled right back to the pivot and found support. How we set our stops is important, and if our objective is to stick with a winning trade, then if we're also incorporating things like this, it makes it a bit easier to manage the trade overall. Because if you are zoomed down into this 30-minute time frame, right? And maybe you're saying, well, what could I use an hourly time frame? Could I use a 15-minute or a 5-minute? Sure, you could use whatever time frame you'd like. My preference is 30-minute because the 30-minute divides evenly into a 7.5-hour session. When price is pulling back over here, the appropriate place for the stop would be either right around the pivot area, right below here, because that's the most recent swing low. If you're looking at this as far as swing high, swing low, then this is the most recent swing low, because price ran here. It didn't, if price would have broken out, this would be your new swing low, but price didn't break above this resistance area, so the swing low is still way back here. Perhaps you could make an argument for this, but that's kind of insignificant level. That might be choking off the trade a bit.
Hey, Mike, can I ask a quick question?
Yeah, go for it, Patrick.
Could you go? Was that weave that you were just doing?
Yeah, weave.
You had there was an orange, or I'm sorry, there was a red block in the middle of the daily that showed
right here.
Well, you were at one point you were showing percentages, particularly when you were showing like a stop level or something like that. I was just curious I forget what indicator that is from the toolbar on the left side that shows that.
Oh, that's the long position. So if you wanted to just put that gives you where the entry would be. You could adjust the stop. You could adjust the target.
Right.
And then it'll automatically calculate the reward to risk ratio based off of your entry, your target, and your stop.
That must have been what you had, because all it showed was red. I mean, it didn't have the green section. But that's what you use to make to observe percentages, whether it's a gain target or a stop loss.
Yeah, that's typically the little indicator that I'll use, or the tool that I'll use. For the purposes of this presentation, I thought that the chart would just look cleaner if I just drew a short line above the resistance and the support levels, so you could see how it lines up on daily and weekly time frames and all that.
Gotcha. Thank you.
Even over here on the weekly time frame, you're welcome. On the weekly time frame, you could see how that ended up being the weekly low. So the more that we're able to incorporate multi-time frame analysis, the more solid our levels will be. I feel like I'm beating a dead horse a little bit with this. Well, we could look at the other examples afterwards if you want, but let's keep things moving. From good to great, using price and volume range decline. Price and volume should contract as price consolidates. This does a few different things for us. If price is not bouncing all over the place and volume is declining, that shows that there isn't a whole lot of activity at a particular price for a particular volume. Together, this is showing us that less supply is coming to market. So if there's less supply that's coming to market and the price range is declining and the volume is declining, then we can anticipate that a move is going to happen in either direction. Sometimes the breakout will work and it'll work out great. Sometimes it'll work out and it'll work for a little while and then it'll fail. And sometimes it'll fail immediately. Those are the best scenarios, and the reason why is because if we are wrong on a trade, it's best to know right away. Because if you do know right away, then you could take that capital and recycle it into something else versus having to wait weeks or even months to know that, oh, this trade was a dud. Also, if you're buying closer to the danger zone, then that means that you could only be risking maybe 1-2%, sometimes 3-4%. For the most that I typically risk on a trade is like 5 or 6%, and that's on the extreme high end of the range. The less risk that you're able to take, the better, because if you are taking less risk, then the trades that do win have less heavy lifting that they need to do. So as price tightens, the risk becomes tighter. As price tightens across time frames, the risk becomes more defined, and we can observe price range relative to itself. Here's what I mean. Now let's go through ELF, and we could see the same thing on NVIDIA. All right, so if we're taking a look at this area in here, right, as prices consolidating, we could see how price ran up over here, how it pulled back, how it started to tighten up in this area. So just by observing the price action, right, you could start to see that relative to the other movements in this throughout the move, this is a relatively tighter area based on the price action. Difficult to see on the weekly time frame, so that's why multi-time frame, one of the things that multi-time frame analysis can help with. Let's take a look on the 30-minute. So taking a look at the full pattern here, the way I'll break it up is to look at this area, and then this area. This is clearly tighter than this. And it's not just based on the amount of bars that are in here, but I'm talking more about the depth. This is clearly less deep than this or that. Another thing that I'll do, though, is compare this compared to the percent daily range over the last 20 days. And this is where this little tool that Patrick pointed out earlier can be very useful. So if I pull up this level here, just to this, I'm not worried about the target just yet, but to get an approximation, to get an approximate feel for the idea, if I'm looking to enter around here, and I'm looking to place a stop around here. Later on, if I do get interested in the trade, then after I'm very interested in the trade, then that's when I'll start to put in the exact entry and the exact stop. At this point, I'm good with approximations because I want to see, before I put in a lot of work into the idea, I want to see, like, does it fit what I'm looking for? So it has about 3.85% risk between the entry and the stop down here. A few things that I want to look at are, well, what's the percent daily range? And the percent daily range at this point is 3.39%. So this is a little bit outside the percent daily range over the last 20 days, but it's still like right in there. It's not dramatically higher. It's not dramatically lower. It's roughly average. Right? So this isn't something that would have me toss the idea. But sometimes you'll find trades where the distance between the entry and the stop is even tighter than what the percent daily range has been. And if that's the case, then those are the kinds of ideas that get me even more excited, because if price breaks out even just a little bit, and it fulfills its percent daily range, then that means that I'm able to get to a profit target quicker. Let's see if NVIDIA fits that mold. I don't think that it does, but let's just line this up and see. Yeah, this was another 3.5% one from back here, and at that point the percent daily range was in the about 2.87, so around 3% at that point. But another way to use this percent daily range is to see, like, well, what is the trade capable of doing? Because as price tightens up, what will generally happen is that you'll see the price range decline. So it's not just about looking at what it's like around the pivot, but also see, well, what was it like back here? Right? Like, well, what was it like for the bulk of it? And for the bulk of it, it's in the neighborhood of 3.5%, 4% or so. So relative to its history, this is tight. If I'm not even looking at this, but I'm just looking at the price action while this thing is consolidating, this is a little bit tighter than the action back here, or back here, or back here. So look for tightness across time frames. Look for tightness not just on the daily time frame. You could also spot the tightness. You could spot it a bit on the weekly. You'll spot it more so on the daily. You'll spot it even more on the 30-minute. And you'll spot it more on the 30-minute too, when you have your moving averages from the daily. That makes life a lot easier. Questions on that? No? All right. Next, when to exit setting stops. So the chart plays an important part for when to exit. It's an important part, not everything, but it does play an important part. The full chart is telling us a story of supply and demand for the stock. So as we are observing the move, and we should look at the full move of the trade, how it started, where it's at now. That'll give us a much better feeling for if we're closer to or further from the end of the move. And by reading supply and demand, we can identify levels that, when breached, shows that the trend is starting to shift. For example, I was looking at SMCI earlier, right? When price was running up over here, at some point in this move, I was in this and I had sold out of the original position that I had from back here, somewhere in this vicinity, based on danger signals. I had attempted to re-enter this with a small position when it broke out over here to see if it would continue its move. Then it consolidated, raised the stop to break even, and then when it's doing this over here, what's it doing? It's violating these recent swing lows over here. And it violated an area that could have acted as that was an area of prior resistance back here, that could have acted as support, but so far it hasn't. When you zoom out and you look at the weekly chart or the daily chart, start by looking at the daily. You can see that, okay, that this might not be rolling over. It's not as dramatic as it looks on the 30-minute, but it's at least continuing to consolidate for now. Exits are one of the areas where styles start to matter a lot more, because if you're longer term, this is a blip. If you're shorter term, this is consolidating. And where you enter the trade matters quite a bit. If your intent is to, and you bought down here and you're somebody that says, I want to ride this thing for a much longer term trend trade, then this has done nothing wrong, right? All it's done is break out and run some more, and it's still holding the 21 period moving average. But if you're someone that is attempting to enter this area up here to try to get a tight entry on it, then this move is telling you that, okay, perhaps it's going to continue to consolidate a bit more. You don't know if it's going to fall below the 21. Maybe it tests the 21, shakes out below it. Maybe it comes back in, tests the 50-day moving average. The guy that's back here might be okay with all that. Maybe, maybe not. But the person that got in back here has a lot more profit cushion than the person that's testing this little breakout up here on the weekly. From a weekly perspective, this hasn't done anything wrong yet either. It pulled back briefly on volume. Was a little bit heavier on this week, significantly lower on that week, and then price bounced, and then it's been heavy. Right, this week was a little bit lighter volume. So far this week, it's only Wednesday right now, but so far volume hasn't been super heavy this week. It's just consolidating. And so far, this week is almost an inside week, less a few pennies, right? It just kind of broke out, hit a fresh high versus last week, but it's only within a few cents. Any thoughts, comments, or questions on any of that? Okay. So let's open it up to other questions that you guys have, whether it's related to multi-time frame analysis or whether it's related to something else.
Hey, Mike. We were chatting earlier about Datadog, do you
Yeah.
do you think we could? That might be a cool example. Like I was just hanging on because I still am developing. I guess I'm still trying to define whether I'm a swing trader or a position trader for longer periods of time. But a day like today really kind of hit home for me. Uh, when I looked at how much percent down the position was today. Talking with you earlier, you mentioned, oh, I was out a couple of days ago because of the number of danger signals you saw. And that might be a cool example, maybe at least for everyone, hopefully in the group here, to have a look at the specificity, if you will, of what you use to say, oh, I should be out by now. Because the hardest thing for me to see right now is you can't just think like everything's just daisies and strawberries. When the market's up on a good day, oh wow, this is wonderful, the scoreboard looks great, all this green. And then you have a day like today where big profits are being taken, or for whatever reason the market's down. It's hard to lose some of those profits. So maybe looking at that might be
Yeah,
an
totally.
idea.
Yeah, and in seeing green is good and red is bad, like that's just putting emotions, it's connecting emotions to our P&L. Like the market doesn't know how we're feeling. It's just moving. So, well, whether it's an up day or a down day, if we're getting too emotionally invested in any of it, then that's it's going to take a toll. And even if it doesn't take a toll on the position that we're in, let's just say that we followed our rules, it's going to make the planning process that much more difficult for the next trade, and it's trading is it's better to be stoic when we're trading. So what stoic means? Stoic means that we're not. It's not that we don't feel emotion. It's that we're not tied to it. So let's take this trade for example here. So this trade was initially purchased back here, and I added a couple of other symbols here so that way I could start to erase some of this other stuff. But this trade was entered here. I like to scale out of trades into strength, and one of the reasons why I like to scale out of trades into strength is because it makes it easier to hold for a bigger move. I found that it's easier to hold for a bigger move if I'm not giving back so much profit. That actually dates back to my earlier days when I was looking at P&L and wasn't comfortable with giving back so much profit. I'm not suggesting that scaling out into strength at 5% and at 10% is the optimal way to trade to get to the biggest return. But it is the optimal way for me to get to the biggest return, because I would be making errors if I'm holding the whole position and dealing with wild swings in equity, if that makes sense. So
That's
giving ourselves...
Sorry for the interruption. Yeah, that definitely does make sense. And I guess I was in the most basic. When I in reviewing anything in IBD, or suggesting taking something off at 20%, or even Minervini saying, when you're up X%, sell half, because the psychology is good that way. Because if it goes down, he says, "Thank God I sold half," or if it continues up, "Thank God I sold half."
Well, one of the great things that I've learned from Mark is to let your performance become a factor in your trading decisions. So what does that mean? That means that as we are journaling and as we are seeing how far our trades run, that's something that we should incorporate into our trading, because sometimes the market is going to be very generous and give much larger moves. Sometimes the market is going to give much smaller moves. So if we're let's just say that we read O'Neill and take IBD, and we are going to take profits at 20 to 25%. Some markets that will be good. Other markets, we might not get close to that. Some markets, we might get much further than that. The 20 to 25% thing is an average. We need to be managing that part in real time. The way that we're going to manage it in real time is by our journaling process, because if we're journaling and keeping our stats, we'll know that, over the last couple of trades here, over the last 3-4 trades, more of them are running further. I understand that markets trend, so therefore, if we are starting a trend of prices running further, then I should give these more recent trades more room. And then later on, when we start to see more stocks not running so far, then that's when we want to start tightening things up.
That certainly makes sense. I would say that within the last 2 years, it's been just what to me seems like a battle. I mean, I basically have spun my wheels for 2 years. And I don't have exact figures, but I would say maybe I'm going to estimate my average loss at somewhere between 3 to 4%. So I should factor that in now that things are turning around and things are more bright. Maybe the market's is in better condition compared to the last 2 years. If I'm thinking 2 to 1, I should be selling in a strength at 10% up and 8 to 10% up potentially as well. Do you agree with that?
Well, I would be curious how far your trade's actually running. I'm not selling at 5 and 10% because of where my stop loss is. I'm selling at 5 and 10% because I'm taking a look at how far my trade's running. On average, my average gain is getting to 10%. Great, so I'll take off half when I get to 10%. As the market's improving and the average starts to get higher, then it could get to 11% or 12%. In tighter markets, it could drop to 9, 8. I believe earlier this year or late last year, it was down to 7%.
Okay, that makes sense. That's obviously just like the bending with the breeze. The trees bend with the breeze, so to speak. I've seen that, heard that analogy. That makes great sense. That respond to the market. I get it. Thank you.
And now let's take that point and compound that with how we going to place our stop. Well, if my average gain is getting to 7%, then can I really afford to take a 7% stop? Well, I'm not really getting a whole lot, right? If you had a coin and if you flip it on heads, you get paid $1. If you flip it on tails, you lose $1. You just doesn't seem like a much, right? It's like, well, what's the point? So in that scenario, I would want to only take trades where my risk could be tighter. That doesn't mean that I'm going to arbitrarily set my stop at, say, 3.5, but I'd want to find trades where, using the multi-time frame analysis, that my stop is at around 3.5, maybe 4. So that way, when I get to my average gain, if it happens to be 7%, I'm still making close to 2 times my risk.
That makes sense and supports everything you've discussed to this point. Absolutely. Just finding consolidation in tighter areas and applying a reasonable stop loss. Thanks for explaining that.
Yeah, my pleasure. The clearer we could be, the easier all this stuff becomes. And the trading, to put it all together, can be a bit complex and a bit overwhelming. And I've been there. It when it starts clicking, it does start to make sense in your head, and I'm glad that it's starting to make a bit more sense for you. Now, with this particular trade, to come back to this, so I gave myself a couple of different ways to exit this one, right? So I'm selling into strength, and then when I sold this last bit, I actually sold it right here on this day. And on that day, the reason why I sold was because of danger signals. Now, danger signals I'm looking at as the weight of evidence that the move might be over, at least in the short term. So when I'm looking at this, I have all the different danger signals that I've outlined, and they're all in the playbook. I don't have the playbook open right now, but you could go look at the danger signals tab. The ones that it happened to have on this day are all outlined right here, and so there were 11 of them overall. If there's 11 danger signals on a trade, then that's plenty reason for me to call it quits right there. Even if price rallies, right? And in this time, quite honestly, I felt like a stooge, right? Like, oh, price is starting to run up. Great. And I sold almost right at the bottom. Sometimes that'll happen, and sometimes you will feel like a stooge. But if you're tracking your stats and you're doing, if you're journaling, if you're doing post-analysis, then it's easier to remember why you came up with these rules in the first place. If I just adopted this rule from somebody, let's say, Patrick, that you just adopted this rule from me, and you didn't really know the rationale or the research behind it, and you're selling here, and then 2 days later, price is back up 7%. You're just like, freaking Mike, what the hell, right? Maybe you are, maybe you're not, but those are the kinds of feelings that I used to have. But the reason why, Mike right now, Mike today is comfortable selling here, even though price is rallying in my face, is because I know that historically this tends to happen, right? Like maybe price gets a little bit of a bounce, but like in general, like this is at least the beginning of some kind of a consolidation. So I'll gladly exit there. And then what I will do is begin to look for new setups, right? And so if I take all this stuff off here, just hide all that. Is this a setup? No, this is just noise. This down here is controlled action. Like price is consolidating over here. The left side of the base is a little bit wider and looser, but it's starting to tighten up in this area. And that's why I bought over here. Versus this is getting wide and loose and wild and whippy over here. I don't want anything to do with that, even if this does break out and go.
So do you feel, Mike, that you saw after at the point when you bought it and it ran up beautifully on the support levels or the EMAs and MAs, as it got wide and choppy here in the middle? That's just something that you've learned over the course of your experience, that this is starting to look messy. And you just mentioned that what has occurred tends to occur. That is that the big price drop, and now it will consolidate again. That's just
Right.
something you
So
picked up over experience.
yeah. So earnings is a couple of days away. So this had it. Well, if I'm take a look into the crystal ball, and the crystal ball is pretty dirty, so I wouldn't trust it too much. But it seems like this would be ready to consolidate for a little while before earnings, and with earnings next week, right? But maybe it slices through the 50-day. Maybe it takes off ahead of earnings. I don't know, but let's take a look at Dash, right? Because Dash is one that I'm still in. Now Dash, and this is my demo one. Like, I'll take off most of the annotations. This is the one that I'm regularly trading on. TradingView gives you all these different views. With Dash, I entered way down here, and I've gotten 1, 2, 3 scale outs on this thing. I have the ability to give this more room, because I'm sitting on profits, and in my mind, this is a stock that's earned the right to have a bit more room. So it ran up over here. I could have choked off the trade and said that, okay, here's it consolidated a bit right here, so prior resistance should be support. But rather than doing that, I left my stop where it was, below here, and left it below the 21 EMA. Earnings is tonight, I believe. Yeah, August 2nd after the close. So earnings is tonight. So I'm still going to hold this through earnings. Now, why would I hold through earnings, right? Because if this doesn't hold, then it's probably testing the 50-day moving average. The reason why is because if it's the objective of the trade, and I've already given this stock so much. It's how do I want to phrase this? I'm able to give this more room because I've taken off profits here and here and here. The last bit of this is only a quarter of the position that I have. So even if this gaps down and tests the 50, I'm not losing all that much, but I'm giving myself the ability for further upside on this trade.
That makes sense. You have the luxury, so to speak, of doing so because you've already captured all your profits, and
right.
A gap down is going to be offset by your profits, and if it runs up, wonderful.
Yeah, exactly. And where I'm at in a position matters. So let's just say I wanted to start a brand new position in ELF, right? And let's say I was trying to get in on this little pullback area right in here. Right? Not a bad idea. We could do the multi-time frame analysis again and see how this would have worked out. But earnings was today. So if I got in right here and had a very tight stop, let's say I nailed this thing perfectly, I would have only been up about 2.5% going into earnings. This happened to work out, but it didn't. At this point in the trade, it hadn't earned the ability to be held through earnings because it hasn't paid me yet.
Yep, that's very clear. Makes perfect sense. I mean, anything I've ever listened to before on whether it's IBD or reading in books is that you need to have a comfortable cushion, and especially the fact that you're taking some profits ahead of time makes sense as to why you can do that.
Right, and so mentally, you have to be prepared with what you're willing to sacrifice for the move, and why. So for for Dash, I'm only sacrificing a quarter of the position if this thing goes back down to the 50-day moving average. If it goes back down to the 50-day moving average, I'm still locking in a gain on that. It's not like this is a loss. All this is all profit area. The only way that this part would turn into a loss is if it would gap down below the 100-day moving average. It's possible. If this trade were to gap down and test the 200-day moving average, I would still be profitable overall on this trade. So when I start to think about, well, what's my objective? What's my overall objective with trading? Is my overall objective with trading to be profitable on Dash? Is it to be profitable on this one trade, or do I have greater aspirations here? And am I going to meet those greater aspirations by one trade or over the course of many trades and by adhering to a set of rules that I've developed? Well, it's the latter. So yeah, for those reasons is why I would stick with this through earnings, and that's provided that, one, it doesn't trigger my backstop at 82.90. Today price fell to 83.81, so it held that stop so far, and it also presumes that by the close that I don't get enough danger signals to warrant an exit before the close. Any other thoughts, comments, or questions here? All right. Well, I hope that was useful for everybody. And if you have any other questions, feel free to hit me up in the chat.